So let me guess, you're smart and motivated, but just don't know about RRSP investing and want to learn so that you know that you're making great investments every day and you can carry on a decent conversation when someone asks you about it. First, I'll teach you all of the basics that everyday person would want to know so you have a good solid grasp on all of the principles. Second, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. So you've come to the right place if you want to learn about personal finance and investing. Third, I'll go into real specific examples regarding RRSPs because if you're like myself, I'm more of a visual learner. And also, I'll give you important updates about RRSPs for 2024 that you don't want to miss. Fourth, you'll learn about some of the biggest mistakes that people make regarding RRSPs and their investments. I try to go real slow with straightforward examples and explain it the best that I can. But if you have any questions or concerns on anything you see, please feel free to leave them in the comments below. An RRSP is great for investing, primarily due to the tax benefits you get from it. It's also a great place to start for first-time investors. Despite what the name says, an RRSP, or Registered Retirement Savings Plan, should actually be called a Registered Retirement Investing Plan, because you don't want to be just putting that money into a savings account and holding it there. You want to actually be investing that money so that you can generate the highest return on your investment possible. The RRSP was introduced by the Canadian government in 1957 primarily to help individuals save towards their retirement. Like I said, the primary advantage of investing in an RRSP is that it's tax advantage because the tax is deferred to a later date. You don't pay any tax right away when you originally invest into an RRSP, you pay it later, hence deferred. But I'll get into that in a minute. You're eligible to open an RRSP account if you have earned income in the past year and filed a tax return, you're a Canadian resident and have a social insurance number, and you're 71 years of age or younger. You can contribute to your RRSP up to December 31st of the year you turn 71. After that, it turns into a RRIF, RRFI, or Registered Retirement Income Fund. You've probably heard the term tossed around. I'll explain more about that in a bit also. When you retire, you must start withdrawing from this RRIF account because you probably have no more income coming in. Or you could purchase an annuity if you don't want your RRSP fully taxed in that year. There is no minimum age to open an RRSP account. You can open an RRSP account through a bank, a trust, a credit union, or an insurance company. And if you're wondering, yes, you can have more than one RRSP account, even at different institutions, as long as you don't go over your contribution limit for that year. Another thing that I'll come back to in a bit. Also, you can set up spousal and common law partner RRSPs and help split the income more evenly between you both. I hope that you're still with me here. I used to wonder and worry about the exact same thing. I just want to make good, informed decisions. Don't worry, I have you covered. So like I said, don't take your RRSPs and put it into a savings account because you will not generate a great return. You want to take that money and be investing it. You will get a much higher return on your investment. Now, how do RRSPs work? Okay, to explain this, imagine going grocery shopping. The grocery store is what bank or institution you choose to make your investments in. When you choose a bank, say that's the grocery store. You walk in, you grab a cart. The cart in the grocery store would be your RRSP account. Now, you have to choose, just like food, what items go into that grocery cart. These would be the investments that you select. The investments you can put into your RRSPs are cash, obviously, GICs, guaranteed investment certificates, securities, similar to stocks. Think like Microsoft, Amazon, Apple, available on designated stock exchanges. Government and corporate savings bonds. Think of them like IOUs. Also, ETFs, mutual funds, treasury bills, term deposits, and put and call options. You can open an account on an online platform such as Wealthsimple, which I think is an absolutely great platform. Or you can go to a brick and mortar place such as a bank, which I'm sure many people are already familiar with. Now, regarding your RRSPs and the investments, you have two options available to you. One, you can select a financial advisor and they handpick and determine what investments are going to go into your RRSP account. They determine this based on your age, your level of risk that you're comfortable with, your financial goals, and many other things to determine what investments would be the right fit for you and your financial situation. The second option available to you is to have a self-directed RRSP in which you are the financial advisor in a sense. You determine what investments are going to go into your account, the allocation percentage of those investments, and so forth. You make all the decisions and are in control. So it's like our grocery store example. Do you want to have someone go and pick out the items for you and they get to choose? Or do you want to do the shopping yourself and then you determine what items you put into your cart? There's pros and cons to each, which I can't get into a lot right now. That's for another video. But think of it like this. Do you want to pay fees and have somebody allocating and determining the percentage of your account, determining your investments, or do you want to do it? You have to know some about investing, but you are in control. You'll learn more. So there's a trade-off to each scenario. Hey, if you feel like you're getting something out of this video, would you do me a favor and hit the like button, as it tells the YouTube algorithm that I'm making a pretty good video that's decent and that people enjoy watching. Also, consider subscribing if you want to learn more about personal finance and investing from a 20-year Canadian corporate accountant. So, like I was talking about earlier, when you make a tax contribution to your RRSP, it is tax deferred, meaning you don't pay any tax on that contribution in the year you make the contribution. You only pay tax when you withdraw from that RRSP. Here's an example. Suppose Michelle earns $60,000 a year. This is her gross income before any taxes are taken off. Then we're going to say, to keep it simple, that she pays a 30% tax rate. This is 30%, including both federal and provincial. So $60,000 times 30% equals $18,000. This is what Michelle is going to pay this year in taxes, combined total and federal provincial tax. So $60,000 minus the $18,000 in taxes equals $42,000. So you know what they say, there's two things for certain in life: death and Windows updates that you have to do every darn day. I swear, I'm updating this computer every day. There's a Windows update, like every second day, I swear. Like 5 minutes will go by, oh, another Windows update. Sorry, that's my rant. Anyway, does anybody else experience this, or is it just me? Am I going crazy? So again, for this second scenario, we're going to assume that, again, Michelle makes $60,000 per year before any taxes are taken off. We're going to subtract immediately that $5,000 before any taxes. So now, as far as the government's concerned, her gross income is $55,000. From there, we begin to apply that 30% tax rate. So $55,000 still times that 30% tax rate equals $16,500. $1,500 less than what she was paying in taxes. So that gives her a take-home pay of $38,500. So see, she is reducing the amount of tax that she has to pay to the government by $1,500. That $5,000 that Michelle invested hopefully grows then in 20, 30 years when she's close to retirement and she has to withdraw that money, then she pays the tax on that initial contribution. So it's not taxed when she contributes and puts it into the account. It's only taxed when she begins to withdraw from her RRSP. That's what tax deferred means. You get that extra $1,500 to invest and earn interest on and compound and contribute towards your investments. It's kind of like stealing from the government in a way, but it's legal and you have a temporary shield until that money is withdrawn. When you withdraw from your RRSP, you must declare it as income in the year that is withdrawn. This can be a good thing, hopefully, that you're withdrawing from your RRSP when you're in a lower tax bracket, because you'll be paying less tax on that withdrawal. I'll explain exactly what I mean by this. One common misconception that Canadians have is that all of their income is taxed at one standard rate. So if you land in, say, the 35% tax bracket, all of your income is taxed at 35%. This is not true. In Alberta, for example, yes, you have a standard flat tax rate of 10%. The Canadian federal tax system is progressive, meaning that it depends upon where you land, where your total net income lands in relation to these tax brackets shown right here. In 2024, if you make $175,000 a year, your entire $175,000 is not subject to a 29% tax. Only the remaining portion above $173,205 is subject to a 29% tax rate. Remember our previous example about Michelle, who makes $60,000 gross every year. Well, let's fast forward 10 years later and suppose that Michelle is now a manager and now she makes $100,000 a year gross before taxes. Michelle doesn't make over $111,733, so her highest tax bracket will be 20.5%, but only a portion of that will be taxed at that rate. She has two different tax rates for her income because her $100,000 lands in both zones, 15% and 20.5%. So for Michelle's $100,000 of gross income, the first $55,857 of her $100,000 is subject to a tax rate of 15%. This leaves us with $100,000 minus $55,867 equals $44,133 remaining, which need to be taxed. The remaining $44,133 is subject to the 20.5 tax rate because this is the portion that was over the $55,867 but under the $111,733. If Michelle made $150,000, that portion over $111,733 would be subject to a 26% tax rate, but only the portion over the $111,733. I really hope this makes sense. Clear as mud? So by contributing to your RRSP, this lowers your taxable income that you can be taxed on. Thus, you kind of skip out on paying tax in those higher tax brackets. So when you retire and you have to start withdrawing from your RRSP, which will then be a RIFT, Registered Retirement Income Fund, which I touched on earlier, then hopefully you'll be in a lower tax bracket than when you initially contributed to that investment. So let's pretend that you're in retirement, you have no other income coming in, and you withdraw $45,000 from your RRSP, your RIF account. So that's all the income coming in. That entire amount, that $45,000, would be taxed at only 15% because you skip out on being taxed because it is under that $55,867, so it's only subject to 15%, and you get to skip out at being taxed at that higher tax rate of 20.5%. So you're already saving money that way too. So to recap, you are saving money when you initially contribute to your RRSP because you are lowering your taxable income. Second, you are saving money again when you withdraw that contribution, hopefully when you're in a lower tax bracket, because you're skipping out on having to pay income because it's declared as income, like I said, when you withdraw from your RRSP, because you're in a lower tax bracket. You're not at, say, the $60,000 or $100,000 level. You're only at the $45,000 level. So your income is much lower. You're in a lower tax bracket. So people may wonder naturally, why don't I just contribute all of my money, my entire income in one lump sum to RRSP? I skip out on taxes that entire year. Well, hold on. You can't. And I'll explain why. The total amount you can contribute to your RRSP each year is made up of your contribution limit for the current year plus any carry forward contribution room from previous years. Your RRSP contribution limit for 2024 is 18% of earned income you reported on your tax return in the previous year, up to a maximum of $31,560. For 2024, the dollar limit is $32,490. So in case you didn't get all that and you're still kind of processing it, it's 18% of last year's earned income up to a set cap determined by the CRA that changes every year. Here's the chart rate around here, and as you can see by the RRSP dollar limit, it's set at $31,560 for 2024. Plus, if you have a pension plan or contribute to your RRSP at work, your contribution limit is reduced by those amounts as well. If you're looking to learn about personal finance and investing from a very educated corporate accountant with a wealth of experience, I'm here and I'm ready whenever you are. And by the way, I try to make it fun and entertaining.
Spartans! What is your profession?
We gotta have a little bit of fun too, right? Can't all be boring, dry stuff. Now, if you haven't contributed to your RRSP for a number of years, I'm sorry, but it's not as easy at just looking at whatever last year's income was and multiplying that by 18% to figure out your remaining contribution room. Now, I know what you're thinking. I don't remember what it's been over the years. I don't know how many times I contributed to my RRSP. I can't remember what exactly my work has put in throughout the years, etc. Relax. It's all on your NOA, your Notice of Assessment. As you'll see by this example here, your contribution room remaining, along with your deduction room, is clearly visible. It's also available online through the Government of Canada, My CRA online account. You have an account. You just need to figure out how to get in there and get access if you've never been on before. Revenue Canada, CRA, keeps a detailed record of all your withdrawals and contributions. That's why every time you set up an RRSP account, it should be from a registered financial institution, because the financial institutions communicate this to CRA and Revenue Canada along with yourself every time you file taxes. However, remember that when you go onto your CRA account, whenever you get in and look at it, it's only updated once every year. So whatever year you choose to look at the data, you're looking at the data as of January 1st of the year you logged in and looked at it. So what is the best time to withdraw from your RRSP / convert it into a RIF account? Well, there's no easy answer for this. It's different for everyone. Everyone's financial situation is unique. However, remember that you always want to contribute to your RRSP when you're in a high income tax bracket, because you're reducing your taxable income. You're lowering the tax brackets that the government can tax you on. So instead of being taxed at 29%, you want to take it out and lower it to where you're only taxed at, say, 24% or lower. Also, you want to withdraw from your RRSP when you're in a lower income tax bracket, because the year you withdraw from that account is going to be considered taxable income. So that's going to be added on to whatever income you have for the year that you withdraw it. So you might be wondering, what happens if I over contribute to my RRSP? Well, you can actually over contribute up to $2,000 and not be subject to any penalties. However, if you go over that $2,000, you're subject to a 1% penalty per month beginning in the month that you over contributed. So I'm going to hit you with another RRSP example just so you get a solid understanding of it. Because if you're like me, I'm a visual learner. I like to see it so I can see the logic behind it, understand the math a bit better. Also, I'm going to throw in the contribution limit just to give a more detailed example. So in our example, Mitch earns $180,000 gross a year. $180,000 times 18% equals $32,400. However, this is where those contribution limits come into play. Remember, for 2024, the limit was $31,560. So Mitch cannot contribute the full $32,400, which is his $180,000 times 18%. He is only allowed to contribute up to that contribution cap of $31,560. Very well, he maxes out that year and contributes $32,400, which is also the amount he chooses to deduct from his income that year. $180,000 minus $32,400, the max he is allowed to contribute, equals $147,600 of his net income. Now pretend it's 5 years later, Mitch is still making $180,000 a year, and he needs to withdraw that money for a down payment on a house. Mitch withdraws exactly the same amount, $32,400, just to keep it simple. He has to declare that $32,400 as income. So his taxable income in that year is $180,000 plus $32,400 equals $212,400. He's going to be paying a lot more in taxes because now part of his income is in a higher tax bracket. So you only deferred your taxes by 5 years, so you made a little bit more, but not near as much as if you had held that money in that RRSP account for 20 years or more due to compound interest, and then withdrew the money when your income is less or even zero. One thing that I want to touch on, but I'm just going to do it at a very high level and just breeze over, but this is particularly for people that have never bought a house and are a first-time home buyer. Now, this is a one-time thing, but it allows you one time to withdraw up to $35,000 that you can withdraw from your RRSP to go directly towards a house, and you don't pay any tax on it as long as it is repaid within a 15-year period. Now, I'm not going to go into too much detail about it. I just wanted to bring it to your attention so that maybe you research it a little bit on your own and look into whether it's a possibility for you and your situation. Also, for those who may be wondering what the term annuitant means, it means holder or owner of the investment. This would be you, as you would be the holder of the RRSP investment. Now, this wouldn't be the complete RRSP guide if I didn't at least mention or touch on the CDIC, Canada Deposit Insurance Corporation. Whew. And at least mention what they do. I think actually this is extremely important for you to know. The CDIC is actually an independent crown corporation established by the Canadian government in 1967 that insures up to $100,000 per account of your investments. The CDIC covers all of these investments listed right here, and as long as all of these investments are through a registered financial institution that the CDIC recognizes, they will insure you. You can find which financial institutions are registered through the CIDC on their website. So you'll notice that I said per account. So say you have $50,000 in an RRSP account. You are fully covered. They will fully cover all these investments up to $100,000. Now, suppose you have $180,000 of RRSP investments, and say that $100,000 of it is in stocks and mutual funds, and the other $80,000 is in GICs. The CDIC will only cover that $80,000 in the GICs. They will not cover the $100,000 in the stocks and mutual funds. That is not one of their covered investments. So this coverage is to protect you in case the financial institution goes into bankruptcy and declares insolvency. It's also important to understand that I said per account. So it's not limited to $100,000 in total. As you'll see by this graph here, it is $100,000 per account that you can have. So it could be $100,000 for each of these different accounts that you are insured upon. The CDIC will cover up to $100,000 of each one of these accounts. So if you have over $100,000 in some of these accounts, I would bring it to the attention of your bank or financial advisor and get their opinion on what your best coverage should be to protect those accounts. Please remember that this coverage only protects you in case the financial institution fails. It does not protect you in case your investments take a nosedive in market value. So if you want to learn about personal finance and investing from a 20-year Canadian corporate accountant, please be sure to subscribe and like this video if you found it decent and got something out of it. Also, I have 2 videos right here, one on job and career tips that you won't hear anywhere else that'll help get you ahead and help you to stand out at your job and further progress your career. And the second on the hidden cost of company loyalty and what it ends up costing you over the long term.